What's going on, Dividend Chasers? It's the Dividend Bloodhound here with another investing episode. In this episode we're going to talk about part 2 of my dividend growth stock recommendations. Now, in the first video I covered my trio of financial facilitator stocks, Visa, MasterCard and American Express, and in this video we're going to move on to some companies that aren't financial or so financially orientated, or at least a couple of them aren't anyway. In this video we are going to cover JPMorgan Chase, I know that's financial, Blackrock, the investment firm, or one of the largest investment firms in the world. Again, I know that is financial as well, but these next two aren't, I promise. And the third one is going to be AbbVie, the large pharmaceutical company. And then last but not least, we're going to do Caterpillar, the big yellow digger maker and bulldozer maker that most of you will recognise because of the global cat brand that everybody has seen. That being said, we're going to get into the first part of the video shortly. Just a quick plug to the channel. If you like what you see here, please hit that like button in the corner if you've enjoyed this video. Or if you're brand new here and have never been here before, please hit the subscribe button in the corner as well. And hit that little notification bell as well. That really helps the channel out. And if you want to see more of my content and more of my grid, basically, this face, please do hit that subscribe button and feel free to share on social media. I'm all about getting the channel growth out there, helping as many people as possible, and I do need the watch time now that I'm over 1,000 subscribers. Thank you very much for that, and I'll see you in the analysis of the first company, which is going to be JPMorgan Chase. Catch you in there. Goodbye. Hello again, guys. Welcome to the next part of this video. In this part of the video we're going to talk about JPMorgan Chase, the bank, and the very, very well run bank, I must say, over in the US, but has global positions and global funds all over the world. It's a extremely well run bank with numerous employees, mainly in the United States, as it is listed in the United States, but a lot of people will recognise this brand from either their investing portfolios or by being in the United States as well. The Chase logo is literally almost as famous as the Coca-Cola brand. That being said, let's actually do some analysis of this stock. So its ticker is JPM. It has a market cap of 289 billion. A PE ratio of 8.83, revenue of 84 billion, earnings per share at $10 or $10.78 per share, a nice juicy dividend yield of 3.78%, and a PE ratio of 8.83. Its net income was 36, yeah, you read that right, $36 billion. That is a huge amount of money to have to one side at the end of the year. It's been growing its dividends for at least the last 9 years in good terms. And just to take you quickly into the growth side of things, there you can see its dividend growth over the last 3 years is 21.5%. That is absolutely huge. Puts it on par with the 3 card providers that financial facilitators that I showed you in the first part of this, in part 1 of this little 2-part episode we've got going on here. And you get a near 4% yield to start off with. That is absolutely brilliant. This company is not in my portfolio yet, to my regret, but believe me when I say that I'm going to add it, I absolutely mean it, and it is coming in the very near future. One thing to just add quickly here is the current share price is $90 a share, which is a bit of a bargain if you ask me. It's been down to $85 in the past, or $83 should I say, and started life just before the crisis hit at $138 a share. So there's a little margin in it for you there once this crisis abates, basically. So not only is there a little bit of a margin there, but there's also a nice juicy dividend and dividend growth going on as well. Hello again guys, welcome back to the real world. So going forward, what we have, JPMorgan Chase, stonking dividend growth over time, a really good yield at the moment of 3.7% to start you off. Before it's even grown anywhere, it is already at a decent yield rate, and then it's growing at that sort of percentage a year. You own this, and over time it is going to grow and grow and grow very nicely, like a little tree in a pot. Your yield and your dividend is going to grow nicely. I'm not recommending this as you directly buy it because I'm not a financial advisor, but all I'm saying, in my opinion, it is a great company, a great stock, and I'm going to definitely be adding it to my portfolio in the next couple of months. Hopefully before the price rockets back up and the yield drops back down. I genuinely, hand on heart, really love the look of this company, and it's got such a good turnover, such a good net income at the end of it. I think it's in really good shape to weather out this crisis. That being said, our next company to look at is Caterpillar, so I'll see you back in there. Hello again guys, welcome back to the analysis centre. Now in this little part we're going to be talking about Caterpillar, the instantly recognisable brand name that you can see there. Everybody's seen these big yellow diggers all over the world and on cap badges and generators and all that sort of thing. And this is a large construction and agricultural and mining equipment company, has been around and paying a dividend for a exceedingly long time. Last I checked, it was a dividend aristocrat, which means it's been paying and raising its dividend for well over 25 years. That being said, let's have a look at the fundamentals here. So ticker is CAT, funnily enough. It has a market cap of $65 billion at the moment. Nice juicy yield of 3.5%, far better than the savings rates would give you at the moment. A revenue of $53 billion, earnings per share of 10.78, and a PE ratio of, very similar actually, 10.79, and has a net income of $6 billion. Very, very profitable company. And today it is trading at a nice $109 per share, dropped 4% today, which is a hefty little jump down as the sentiment and bull sentiment in the market seems to be fading due to the oil price going negative, which I've never seen before. I think that is a record. Anyway, yeah, so we are down today at 109. Well, I think it has been lower in the last couple of months. I am right. It has dropped to $91 on the 22nd of March. But where was it before that? So in the last year, before this crisis properly kicked off, it peaked at just over $150 a share. So again, there is a bit of a margin in this one for you if you buy and hold for the long term. This is by no means a recommendation, but just me saying I would buy and hold. In fact, I have one of these shares that I bought for a similar price to this one, and I plan on keeping it for the very long term. I know I already mentioned that it's a dividend aristocrat, but let's have a look at its 3-year dividend growth, which is what this video is all about. And we can see here it sneaks in at 7%, a 7% raise over a 3-year period. Now that is absolutely brilliant. Again, to start off at such a high yield and then to have this dividend grow at 7% over 3 years is absolutely excellent, and proof of and testament to how well ran, well managed and profitable this company is. That being said, there are some headwinds ahead due to this crisis that we're experiencing at the moment, but I think construction, at least here in the UK, has actually carried on. They're distancing, but they're actually carrying on regardless in most parts. So I would say that that could mean the same for the global construction industry, potentially. Hello again, guys, thank you for sticking around. So what did we think of CAT? It is really strange to see like the diversity of the companies that do this sort of thing. I mean, on one hand you've got the big financials, but then you've got a construction equipment and mining equipment manufacturer managing not quite to raise in the same sort of terms as the big financials, but this company has actually been growing its dividends for a lot longer and still remains extremely profitable and one of the most famous construction brands in the world. So it is in an ideal position to weather out this crisis in the long term. It forms part of my portfolio, as I think I already mentioned. It is just the one share, but it is something else I'm looking at while prices are so cheap at the moment, to add that, and I get a little bit of margin for the appreciation in the share price over time, and then that yield and that dividend and my yield on cost over time is only going to increase and increase, and that is exactly why I want to boost that position again in my portfolio for the long term. That being said, let's move on to the next company, which is going to be AbbVie. We're going to have a look at AbbVie now. Catch you back in there. What's going on again, guys? Welcome back to the Analysis Centre. In this little part we're going to look at AbbVie, the huge pharmaceutical company based over again in the United States, which is what all this video is all about. This company is a huge pharmaceutical company. It'd be impossible to go into everything that it does, but it's very it's very well known for its growing dividend, a very well known brand since it broke off and formed a separate company from Abbott Laboratories, and it's probably most famous for its Humira HIV treatment, but it does actually deal in a lot of cures for other diseases, and gives out obviously vaccines, or sells, should I say, vaccines and drugs to abate some of the most horrible conditions and diseases in humankind. So with that being said, let's actually have a look at the fundamentals of AbbVie. So its ticker is AbbVie, ABBV. Its market cap is 123 billion. It has a PE ratio of 14.49, revenue of $33 billion, EPS of 5.76, and a net income of 7.88 billion, which is a huge profit to be making, of course. If you include its time in as part of Abbott Laboratories, this company has been growing its dividend for 47 consecutive years, which puts it pretty close to king status. But there is some argument to be had there of whether you can include most of these years, because it only became its own entity a few years ago, but it was formed part of a company that has been paying its dividend for a very long time. So it's very hard to argue the points, but it has continued to grow its dividend every year since the company came into existence, and as you will see here shortly, it's been growing it at an absolutely incredible rate as well. So if we have a look here, its 3-year growth is 23.36%, which is well on par with keeping up with the big financial guns that we covered earlier on in this video. And the company has done that year on year on year, and is well known in investing circles for growing its dividend at an incredible rate each year, much superior to the rest of the market, which is no testament to AbbVie's management and the use of its product. It's had a bit of a topsy-turvy share price at the moment, as you can probably see by the little chart here. Its current price is $81 a share. It's been down in the midst of the crisis. It dropped down to $63 per share, and I think it did the same back in August. Yes, it did. And it has been up to a peak price of $95. So the health crisis forced a drop in the price that is now recovering from, and then back over here, back in August 2019, it was realised that AbbVie's dominance with its Humira HIV treatment, the patent on this was coming to an end, so other companies will be able to imitate it, and its market share for this drug overall will slowly drop, meaning a drop in revenue. However, it was then realised that it had a playbook essentially of loads of other patented drugs that should be able to pick up the slack, which then meant a big increase again back in the share price. So if you were lucky to buy in here or here, that was a really good time to buy. I bought in at, I think, about $65 per share, which was a good time to buy. The yield on this company is already 5.66%, and based on that growth rate, that this is just going to be an insane company to own, and will probably be the big, as long as it doesn't cut its dividend. Some people are a little bit worried about the sustainability of it. This will be your biggest payer out of these, all the companies that I've covered in this video. AbbVie will be your biggest payer, most like. Welcome back to the real world, guys. AbbVie then, what a great company. That much growth in its share price, that much growth in its dividends, over 21% over 3 years. That is absolutely insane, and it has grown that dividend at an impressive rate since the company's very inception, since it broke off from Abbott. I'm sure there'll be people out there that will argue with me that GSK is better or is more diverse, or Johnson & Johnson has got the better history, which is, yes, very true. They're a dividend king, and I take nothing away from Johnson & Johnson, and I'd like to add them to my portfolio as well. But AbbVie is already in it for the simple reason that 5.6% can't be ignored. The growth rate of their dividend also cannot be ignored. As long as it's sustainable, which it looks like it is with the new products that they've got coming, and they still have dominance in their main drug at the moment, so hopefully there should be a nice changeover where the revenue isn't affected that much. And that means that suggests to me, and this is only me, it's my own research and my own opinion, so please don't just blindly copy, please do your own research. But that guarantees it a spot in my portfolio. I have 5 shares in it right now, and I'm looking to add more, because that yield over time and yield on cost is just absolutely insane. And this, as I said earlier in that little video, it'll be your biggest dividend payer. The only concern is the other companies that I've covered are probably a little bit more sustainable or a little bit more guaranteed at the moment. But the risk involved in this isn't that high. All I'm saying is it's a little bit more risky than in terms of sustainability than the other companies that I've covered. But I'm not saying that their dividend or that yield is at risk in any way, shape or form. It's just something worth considering. That being said, it's finally time to cover my last stock in this video, and that is Blackrock, the known to be the world's largest investing company and investment platform. And yet we're back to the financials again. Catch you back in there, guys. Hello again, guys. Welcome to the last segment and the last stock of this video and of the little mini 2-part episodes that we've had so far. So the last stock we're covering is Blackrock, known to be the largest investment management company, or one of the largest, especially in the world. In fact, I think it could be the largest. I read that it has over $6.96 trillion under it of assets under its management. Now that is absolutely enormous. It's almost beyond belief. That is more than the GDP of pretty much every country in the world, apart from the top G7 countries or so. Most countries, this company looks after more assets than their GDP is worth, which is absolutely insane, really, quite frankly, when you think about it. So that being said, let's have a look at its fundamentals. So its ticker is Blackrock, has the ticker BLK, has a market cap of 73.96 billion, a PE ratio of 16.78, revenue of 14.54 billion, earnings per share $28.43, a dividend yield of a healthy 3%, and a net income of $4.48 billion, a very healthy profit to make indeed. Currently trading today at $470 per share, $471 per share, I stand corrected. Dropped all the way down to the 300s at one stage, 329 in the midst of this crisis, I believe, if I look back properly. Oh, it's playing up a bit. Oh, this is getting annoying. 350, we'll call it 350. So it drops down all the way to 350 at the start of this health crisis, and has been at a peak of $565. So even at this moment, there is still, even though there has been a large scale recovery, there is still a significant margin to own this stock in appreciation terms, let alone the actual 3% dividend that it pays. That being said, it has dividend growth of over 10 years and has paid its dividend, or raised its dividend, over the last 3 years, a healthy 12.95%, which is no mean feat, and based on a healthy dividend yield starting at 3% anyway, that is a really good return, and I am desperate again to add this. It's just too expensive to buy outright as a share for me. Usually, in terms of what I put in each month, I'd have to get a significant increase to my pay to be able to just land this in one. At the moment, maybe if it dropped down to where it was, I could try and get hold of it. But fractional shares are available on Trading.2, so I could pick it up on there in terms of half a share, or I'll have to wait until I get it on free trade as a whole share, or until they introduce fractional shares. But I would much prefer to get hold of it as a whole share. I don't know why, I just like having round numbers in my account when I buy. But then if I was to drip feed into it, I don't mind then picking up 0.4 of a share or 0.3 of a share as it's being drip reinvested. That being said, this company has such a huge portfolio under its management. I don't think that yield is under any sort of risk, and I don't think that growth rate is under any sort of risk either. Hello again, guys, back in the real world. What did we think of Blackrock then? What a huge company. I did not know until I started researching these companies out. I did not know that there was a company out there, obviously called Blackrock, that managed nearly $7 trillion worth of assets. I mean, that's almost unquantifiable in terms of numbers. Obviously it's not, but the sort of, if you were to put all that money in terms of paper form, the ground and the weight of it would be absolutely enormous. It honestly, it has absolutely staggered me, and that is almost why it's spurring me on. Although its fundamentals are great, as you've just seen, that's what's spurring me on to own a little piece of it. Is just that much wealth managed by one company is insane, and who is going to want to move their money away from that, where they are experts at doing it? They're experts at having so many assets under their management. No one's going to want to move away from that, and they've well trusted clearly by some of the wealthiest people in the world, I would say. So why not buy a segment of their operations? And it's got a healthy yield to start off with, already pays a nice healthy yield, and is growing it at such a decent rate as well. Now is a good time to get in. I can't quite afford it at the moment, much to my annoyance, until I get fractional shares on free trade, unless I get some sort of bonus. I'll have to weigh that up, but there's so many other stocks out there at the moment. But I'm just making this recommendation out there. I'm not saying that you should buy it. In my opinion, I would. I'm not saying that you should. Please do your own research. But I've highlighted some nice fundamental numbers there for you to look into and a base for your research to start. That being said, that wraps up today's video. I hope you've enjoyed this little mini two-part series as much as I have enjoyed researching it and finding a couple of new companies to add to my portfolio. Really looking forward to that. That being said, if you loved this video, please hit that like button in the corner. That will help me out massively. Drop a comment below if you would buy or you wouldn't buy what you've got. Thank you for sticking around as well. I really need the watch time in my videos at the moment, so if you have stuck around for the whole video, thank you very much for that. That is absolutely great. And that being said, I will catch you in the next video. Goodbye.